I still don't think that this is going to be a severe recession from an unemployment standpoint. However, the amount of consumer debt that's out there is really troubling, especially millennials and Zoomers, and housing rates to be weak for years to come. I I I just I think way too much is priced into this market.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Inflation has dropped to 2.9%, and retail sales for July just beat expectations. That's good news, right? But unemployment has risen to 4.3%, triggering the Sahm Rule recession indicator, and credit card and auto loan delinquencies are spiking. So wait a minute, those sound pretty concerning. So what's the true health of the economy right now? Are we still on track for a soft or no landing scenario as we've been told for many quarters? Or might it be wise to start preparing for something harder? For answers, we're fortunate to speak today with someone who tracks the unfolding macro data on a daily basis, Mish Shedlock, publisher of mishtalk.com. Mish, it's great to see you again. Thanks so much for joining us today.
Pleasure to be back on. This is take two. We recorded this for the last jobs number, and we talked and I said, my God, throw that all out the window. And a lot of economic reports out today. So where do you want to start?
Well, let's dive into some of today's numbers. But yeah, I do want to thank you for coming back on. And again, folks, Mike and I recorded a little over a week ago. And to Mike's credit, one of your quotes there, Mish, was, hey, I think we're actually in a recession already. And then I think within 24 hours, we had the triggering of the Sahm Rule. Then we had the big market sell-off that following Monday, and lots of that due to the unwinding of the yen carry trade. But so much of what we had recorded so much had happened that we decided, you know what, let's scrap what we recorded. Let's record anew. So again, thank you for taking time out of your busy schedule to do this twice with me. All right, well, look, I got a bunch of questions for you, but let me just start with the general question I like to kick these discussions off with. What's your current assessment of the global economy and financial markets?
Recession for the US. I'm pretty convinced of it. I'm even more convinced of it despite today's retail sales numbers. We can go over why if you're interested.
Okay, so US increasingly heading towards recession. Real quick, rest of the world, any opinion on the rest of the world economy?
China looks really weak. I just saw some reports on that where their consumer spending is down. What that means is China's going to try and make up for it the way they always do, which is exports. That's going to put some price pressures on goods, I think. It's also going to raise the ire of Biden, of Trump, of Kamala, of the current administration, and whoever wins the next one, I think. But especially if Trump wins.
Okay. I got a question about China, but I'll hold on to it for a sec. Lastly, again, very high level, we'll get into the weeds on this a little bit later in the discussion, but state of the financial markets right now.
The financial markets, if you mean with consumer credit, all the reports look like a disaster to me. We've got rising delinquencies across the board, more so with the Zoomers and millennials, but we're starting to see some upticks across the board in delinquencies in things like auto loans. And people say, oh, Mish, they're lower than 2009 or whatever. Okay, coming out of the Great Recession, I would hope they would be lower. Actually, they're about the same as those 2009, 2010 levels right now, except, Adam, they're going the other way. They're rising, not falling.
Okay, and I want to talk more with you about those. I was more specifically asking just about stocks and bonds. Do you think they're fairly valued, overvalued? Are you worried about a market correction, or do you think things look
market
promising from here?
Well, I'm probably not the best person to ask about a market risk recession. It's looked overvalued to me for years. So maybe ask somebody else. I'll just admit how wrong I've been. I never thought we'd get this far. So my forecast for bonds is usually a lot better. I think 10-year yield is going to come down, spiked a little bit today. I think I'm going to guess off of today's numbers. And I forgot to look before we went on to check and see what the odds are for a September double cut. I'm guessing they dropped today, but guess what? I'm still sticking with my 50 basis points, 2 cuts for September.
Okay, bold statement. We're going to talk about that too. We had a little back and forth over Twitter. We're also going to talk about the labor force, the employment stats. And I do want to just remind the audience that you and I had a bet going for 2023 about where we're going to end the year on an unemployment rate. I took the over on that and I lost. And then I asked you if you would double down with me. You kindly did. And while I feel like things are beginning to go in my direction, it's been long enough that I conceded. So after we recorded a week ago, and I had to call you and basically ask you if we could scrap that and do this one, I did make good, and I paid you for that bet. But
that's
maybe
correct. 2 pizzas and beers, folks. Adam and I bet heavy.
we did. Well, I'm glad you're getting to enjoy it this time around, but maybe by the end of this conversation, we'll have made another bet for the end of 2024.
Okay.
But jumping in here, so we had some relatively favorable on the headline level data reports come out in the past 48 hours or so. So we had CPI, headline CPI came in, it dropped down to a 2.9 handle. And so people are cheering that. And I think optically that helps the Fed, right? The Fed can say, yeah, we're still making progress. We're now in the 2s, and 2.0 is not that far away. And then we had the July retail sales numbers come out, and they were a big beat to expectations.
Enormous.
And it was the biggest month over month beat we've had in a good while. Now, people are cheering that. With everything, we look under the hood of the headlines and we see oftentimes a very different story. What is your reaction to those new data releases?
Well, first off, let's go with the report that I can brag about. Because the day ahead of the CPI, the consensus was no change year over year. I predicted 2.9%, which was a 10th drop, the first time below 3% since March of 2021 or something like that. I forget the date, but first time in a long time below that. And I was pretty confident of that number, and I was, right. But there were some surprising things about that. And price of rent went back up, and I had thought we were on at least a down slope in the rate of change on rent. We had 33 consecutive months of rent and OER both rising 0.4%. We broke that string last month. I figured we would have a little bit more downside. We didn't get it, yet we still beat the street year over year. And just for projecting, as long as we're making them, I think we're going to see at least 0.3% decline next month in the year over year, and at least 3 more tenths in the month after that. It wouldn't surprise me to see something like 2.1, 2.2, 2.3% year over year after the next 2 reports. Okay, so that's what I got right. Now, I didn't make a projection on this, gratefully. But my mental projection on retail sales was they weren't going to be any good. Well, they rose 1%. And when I looked at that headline number this morning, and then I looked at the rest of the reports, the trade reports were pretty good. Export prices were up, import prices were down. oh mercy. I said, what the heck is GDP now going to uh do? And it actually fell. And I looked at that, so I was shocked twice today. And we had these amazing numbers, and GDP now fell. So what the heck is going on here? Well, I failed to look at another report that came out today. Industrial production was an absolute disaster, and we had negative revisions as well. But meanwhile, I'd already emailed Pat Higgins at GDP Now. I said, what the heck happened to CIPI? That's change in private inventories, because the entire hit to GDP Now was not where you would want it, actually, if you're forecasting a recession, but it was in an inventory adjustment. So tying it all together, it kind of makes sense between the two reports, the industrial production and the retail sales, all balancing out to a flat number. But the bottom line, real final sales didn't budge at all. So we just had a drop in the top line number. Here's a statement I got from Pat Higgins, the creator of GDP Now. We exchanged a couple of emails on here. I'll try and condense it here now. And the reason why GDP Now dropped the overall forecast was it had to do with industrial production for motor vehicles and parts. And assemblies fell 12%.
Mm-hmm.
So that accounted for a lot of the drop in that. And
sorry to interrupt, but that just suggests slowing demand, slowing consumer demand for cars, correct?
Yes, but this is what's so weird about the retail sales report today, because most of the rise, or a huge portion of the rise, I don't know about most, at least half, I think, was due to motor vehicles and sales and parts. I look at these numbers and I'm still trying to make sense out of them. I happen to have a conversation with Lacey Hunt today too. He goes, I don't believe these numbers. And his economist friend, I'm not sure her name. I don't think it's the same one that did some other reports. But anyway, her estimate was 0.3% for retail sales. And she goes, apparently this person doesn't believe the numbers either. So, and looking at motor vehicles and parts, these are off the top of my head. I might have them backwards or slightly off, but they fell like 3% last month and rose that same amount this month almost. So the last 2 months were a wash. So, what's really going on here? And I don't know, but a lot of people might not know this, Adam. They count motor vehicle sales and parts sales when the cars are shipped from the manufacturer. When GM ships cars to the dealer, ding, 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 that counts the sale. Whether they sit on the lot for 120 days, well, apparently it's still a sale. So I would say that I would object to the way they come up with these numbers. So I'm wondering how many sales we really have versus shipments. And to tie one more idea back in line, possibly what's going on here, I haven't had a chance to bounce this idea off of anybody, but I'm wondering, those EVs are sitting there on the lots, they've shoved them off, they've hidden them somewhere because they're not selling. And they ramped up production of what is selling. And maybe that's the surge in sales that we've seen, is a delivery of internal combustion engine vehicles to the dealer lots. I don't know. This is all speculation because I don't like the way they tabulate sales for autos. But that was a big part of the number today. And it doesn't add up in my mind, in Lacey's mind, or this economist whose name I do not know at Bloomberg.
Okay, so and I've been having this discussion with a lot of economists on this program recently, like Claudia Sahm and
Mhm.
Anna Wong from Bloomberg, which is, how much there seems to be a lot of data points out there that are head scratchers like this. And of
Oh,
course, when we get to
today,
the
yeah.
jobs, when we get to the jobs numbers, they're replete with examples of this. And so I asked them, I'm like, is the data less trustworthy than it's been on average in your career? And more or less got a yes out of them, right? And I sympathize with them because their job's a tough job to do anyways, which is, trying to predict something that's hard to predict. But when you're doing so with data that you don't have a ton of confidence in, it gets even more nerve-wracking if you're putting your name out there, right, with projections. So, this is a potential example of that, and there's questions of like, is the data distorted for understandable reasons? And maybe in the employment space, we can talk about that because there were massive disruptions to the employment numbers during
Yeah.
COVID, and maybe the bullwhip effect is still, rippling through, right? I can get that.
Well, I
But
have an answer, a specific answer for that I'd like to go over, but go ahead and finish.
all right, but let me finish the point because I'm getting to somewhere with it. The second is, or is there like deliberate manipulation of the data to try to make it look better than it is? And some might say, well, for sure, especially during a presidential election year, and they're doing everything they can to put lipstick on the pig. But a good example of how the data, like why that's a valid concern. I'm not saying it's true, but why it's a valid concern is let's look at the retail sales numbers here, and like many other data series that we're seeing a lot, in recent quarters. The last period's numbers, so the June numbers, were just revised down tremendously.
Yeah.
And so, yeah, compared to those dramatically revised downwards number, that's where you get that really big percentage month over month gain, right? So here's the chart here, and you can see, of this data set, what is this? 70+%, 75%. The revisions are always to the downside and pretty substantial. So, I guess my question is like, how much faith can we put in these data sets? Because it seems a lot of the times we're being told something and we're like, that just doesn't make much sense. And then a month later, the authorities are like, oh yeah, we radically overstated that. We're revising that down. But don't worry, today's number is a huge beat.
Is the data less trustworthy? Absolutely. Is it manipulation? No. I don't, Adam, I hardly buy any conspiracy theories. And I get into it with people on Twitter, and I probably ought to just shut up because you're not going to convince anyone who thinks that they're trying to save Biden or trying to save Kamala Harris or whatever. Yeah, there's certainly manipulation in the media, but not about the economic data, I don't think. Is the Fed distorting the data? No. Do I think they would rather Trump not win? Of course, yes. And if they do cut twice, there's going to be the charge, but the data will either support it or it won't. So I've talked to the people at the BLS, but I see it from my readers, and a whole slew of them, for whatever reason, yesterday, they don't normally disagree with me so vehemently, but it's like, well, none of this is true. It's all manipulated. This is for the election. We don't even know what the people's personal attitudes at the BLS are. If there was some sort of massive conspiracy, it would be out there. Have we seen some things in the past? Yeah, you go back historically, they changed the way that certain things were done, but they announce it. And so I don't think that's going on. What I do think going on, particularly with jobs, is the birth-death model has absolutely gone haywire. And I did my own calculation. I came up with, I'm just going to make up a number here, 789,000. I think that was my number.
Mm-hmm.
Of how much overstated
Payrolls.
that model has added. And right after I came up with that number, and I sent it to Lacey Hunt, and he goes, well, did you know Anna Wong came up with the same number? I said, no, I didn't. She came up with 730,000. So, what we're looking at here are two different data sets, Adam. The monthly jobs report is based off of, as of the end of December 2023, 666,000 samples of businesses. The QCEW and BED reports, the quarterly wage reports, are based off of 11.9 million, I think, for the QCEW, and the business employment dynamics, which is the subset that they use to verify the birth death model, is 11.2 million. So you got 666,000 plus a birth death model that nobody understands how it works. And then revisions come out later based off of the QCEW and BED reports, business employment dynamic. So Anna Wong and I essentially came up with the same number. I'll just go with hers, 730,000. Now, I did a separate projection based off of the full QCEW and came up with something like 900,000. I don't know if Anna Wong has done that or not. So we're looking at, if we're right, at least I'm in good company, revision somewhere between 700 and 1 million. And that's just for through the first quarter. We don't have the first quarter revisions yet coming out from QCEW. That comes out, I think, on August 21st, if my memory serves me correct. And that's when we're going to see these revisions hit for the first quarter. Now, bear in mind, it's August, and we're talking about revisions for, well, I don't know whether you want to average it out, but through January. So it was either, 5, 6, 7 months, something like that. Call it 6 months late. But everyone has a lot of faith in these jobs reports that by now should be clear are totally bogus, because the QCEW matches the discrepancy between the household survey and the establishment survey. The establishment survey is jobs. And one more point, because I think we talked about this last week and I almost forgot it. The ADP report last month, and this is the first time I've actually went into the detail other than looking at their headline numbers. But I downloaded their data, drew out some charts, and it's like, oh my God, look at this. Year over year, businesses that have between 20 and 49 employees, employment from a year ago is down 88,000. I mean, that's pretty amazing, because businesses of size 20 to 49 employees have as many overall employees as corporations with 500 or more employees. They're equally important. And also, one trend in the ADP data was every class size business other than 500 and over was heading south. Wasn't negative, but it was trending lower. 500 and up was trending higher. Now, when we look at things like Intel laying off 15,000 workers, how long is this 500,000 plus going to keep adding businesses? I'm pretty confident here that we're going to see a very sharp slowdown in jobs, maybe even in the next job report.
All right. And just as a reminder, the vast majority of jobs out there are created by smaller and mid-sized businesses. So it's almost sort of like the mega cap companies can go on a massive hiring spree if they want to, and I don't think they necessarily are right now. But it's still not likely to overpower whatever trend is happening in the bottom 80%. of the employment
Yeah,
market.
the employment size 1 to 19, single proprietors like you and I'm assuming you're a single proprietor. And no one ever surveys me, by the way. This is what I think is happening. This is where I think the birth death model went wrong. I think they oversampled large corporations, undersampled small to medium sized corporations, in their 666,000 sample versus like the 11.9 million. That's my guess as to what went wrong, but that may or may not be right. But small business or tiny, if we make a distinction, 1 to 19, that's still positive. It was just that 20 to 49 that went negative, and add them both together, I think it was slightly positive, but that is a huge, huge subset of the overall job picture, businesses 49 and under.
So, all right, I got a lot of questions stemming off of this, but they all kind of nest under my open question from the intro, which is, okay, so we're having, these cross currents of data, some saying things are fine, some saying things are not. I hear you saying, look, the employment situation is not great and getting worse.
Correct.
And you can't build a solid economy on top of a deteriorating labor market. So why, let me ask you this. When do you think it's no longer going to be a debate, right? Because, I would think, listening to a lot of the stats you just came up with, we're overstating employment by, anywhere from 3/4 to a full million. Employment is down, in almost every category.
Trending low
and trending lower too. Yeah, it's down and trending lower. So like, I don't think you'd be able to hide that for very long. So when do we get to a point where we're going to start seeing in the data, okay, yeah, Mish is right, like we're totally and arguably in a recession?
Sometimes it takes a while. If you look back, even at 2008, at the start of the recession, believe it or not, jobs were still positive. Industrial production was still positive. So then it was like very sudden in 2008. I don't know if it's going to be that sudden here, and I doubt that it is. So we might be arguing about this for a while, but at some point, it's just going to be apparent. In 2008, it was apparent really fast. When you look at the recession indicators, and I can't go back and see what people were debating at the time, but some of them lagged by as much as 7 months. So, it's like mercy. So if this indicator is lagging now 7 months, then my gosh, we're in the realm where Daniel DiMartino boosts October of 2023 is possible. I seriously doubt that, and I've got some more numbers that make me even more doubt that. And I don't know if this is a good time to go into those numbers, or you have another question.
No, go into the numbers. I've got an infinite number of questions here, but if you got numbers, this is a good time.
I've got an infinite number of answers. I always tell people you can ask me anything. You just have to be prepared for the answer. So anyway, that's my philosophy. If you ask me,
and I'll make sure I ask Mike, what's the meaning of life before we're off camera.
But well, I mean, I'm not guaranteed to answer. You just have to be prepared for anything I say. But I found a report a couple of days ago. It was based off of the one that everyone's talking about now, the McKelvey indicator. Claudia Sahm revised it a little bit to her liking, but the problem is it has false positives. And she got rid of the false positives by cutting off the data at 1960. And possibly, I've not confirmed this, I'm going to crunch some numbers. Anyway, it came real close. By my calculation, with her method, 0.48, where no, but okay, 4.8 isn't 5, but I'm questioning, but I don't know how we got to 4.8 and whether or not it was really 5. But anyway, what you really need is a confirming indicator. And it's interesting because I'd been looking for one and couldn't find one. But I saw a report today or a few days ago, and I've finished downloading it and working with it. Unfortunately, I can't pronounce these guys' names. But well-respected economists. They took the McKelvey indicator, and they also looked at job openings. Job openings divided by the labor force, 3-month moving average, the same as the McKelvey, the Claudia-Sam indicator. And it gives, and you can imagine, the unemployment is going this way, right? And job openings are going the other way. So, but most of the time they're in sync. But the times that McKelvey was wrong, a false positive, the other indicator said, no, we're not in recession yet. And anyway, I combined these two indicators. Well, actually, someone else did. I merely recreated the data. They were, when I do my report, I will link to it. Anyone can download this data. It's kind of messy to work with, but I figured out how to do that. But anyway, if you line these two things up and say there's only a recession when both of these two indicators agree, guess what? No false negatives or false positives all the way back to 1953 and 13 recession, maybe it's 11, something like that. And based off of that data, we're in recession now.
Okay, I was
100% of the time, we were in the conditions that we're in now. We were in recession all the way back to 1953.
Okay, so that gives you additional confidence in your original statement you made in this video, which is, hey, the U.S. is in recession.
Yes.
Let me ask you a question about this. I'm leery of anything that depends on job openings.
I don't blame you.
Yeah, well, in the modern era, in the digital era, I wonder if job openings are different, if that factor
Oh,
got
they're absolutely
distorted.
different. And this is the interesting thing, because I would have thought exactly like you did. Personally, I think the people who came up with this deserve a Nobel Prize in economy. And I mentioned that today to some, because what they did was, fortunately, they had a little bit of overlap. The BLS JOLTS report, job openings and labor turnover, JOLTS, started in 2000. And they went back with this model and they overlapped by about 8 years. But they constructed this stuff. They constructed this stuff based off of newspaper ad reports, whatever, various sources. I have no idea how they did this all the way back to 1951. This data went back. And, so how did they, manage to do this? But then in the period that overlapped, it all tied together. They've got this 8-year period where they were able to make sense out of openings. Now, the weird thing though now, which lends credence to your suspicions and also mine, by the way, is this indicator, started going nuts, suggesting, hey, suggesting recession late last year, we've got a few months here where I don't like it. Something is really weird happening with openings. Maybe what it is they're crashing so fast right now that it put this indicator into recession mode.
That's good to hear, and only because that's been my suspicion, right? Which is that companies have been labor hoarding and trying to, make things look as good as they can, and so they've had all these sort of phantom openings, right? Which are there either because the company wants to project a level of health that maybe it doesn't have, or for other reasons, other reasons that are separate from, hey, we're looking to hire a person for this job, today. And at some point, I've feared that the companies are finally going to get into real serious mode about like, hey, look, no, we are not hiring and we don't want people applying anymore. And then poof, you're going to see a large amount of these openings appear all at once. And it sounds like you're saying maybe we're beginning to see that in the data.
Yeah, you mean a decline in the number of openings, actually.
Yeah, because it costs them nothing to just in today's era to A, post them online, right? But B, I also wonder too if there's overcounting, because hey, if I put it on my company's job, the part of my company website where we're hiring, and then I list it on monster.com, and then I put it on Indeed, and then I put it on all these other engines, is that getting counted multiple times when it's really the same job?
Well, we're no longer using, the data from this researcher that I'm talking about. Starting 2001, this method is using the JOLTS data. So, and he discussed that in his paper about, what might be happening right now, related to the pandemic. So, when we're merging these two numbers, like I did and said 100% of the time we had these conditions, we were in recession. You can look at this data and say, well, okay, what's really going on here now? Did these openings ever exist in the first place? Which is, if you're skeptical about that, then join the club, because I thought a lot of these openings were bogus, and now they're taking these bogus indicators away. I think that might have triggered this thing way early. I don't know.
Okay. Well, either triggered it way early or made things look better than they were for too long, and now reality is catching up to the data. One or the other.
Yes.
Okay. Okay. Now talking about additional. Well, let's put it this way. Let's switch to a prediction that you have that I pushed back on a little bit, and I'm not pushing. I'm not making a prediction here, but I want to give you an opportunity to make your case for why, and it sounds like you're still willing to stand by this. Why you think coming up at the next FOMC release in September, you think the Fed is going to cut 50 basis points, not just 25?
I think retail sales are going to be revised low. I think the next job report is going to be a disaster. I think the next CPI report is going to be amazingly good for those three good reasons.
Okay, so in that is you're expecting deterioration between now and then to drive the Feds. You're not looking at the status quo numbers and saying this deserves a 50 basis point cut. It's because you expect some additional shoes to drop between now and September.
Correct. But what it might depend on now, after today's numbers, is either a really big revision to retail sales, or a pretty big disaster in jobs, or some sort of revision and a pretty bad jobs report. Oh, one more thing today. I'm expecting, and I'm not crunched a number yet, but so this is off the top of my head because I'm just thinking about it. One thing that came out of the CPI report yesterday that I've not even written about yet, because I'm saving this up as opposed to do, is we did talk about the price of rent went up 0.5%, which kind of surprised me. OER, shelter was up, the whole index was up can't remember whether it was 0.4 or 0.5%, but a pretty big number that I did not expect. But medical services declined 0.3%. Okay. Now, if you know how the way these surveys work, shelter is 36% of the CPI, and it is far less. I'm going to guess at a number, maybe 19% of the PCE. I don't know the numbers, so don't hold me to that. But medical is reversed. PCE overweights, healthcare, and we had a big drop there. So it wouldn't surprise me in the least to see. I've not looked at all the numbers here, but a flat to 0.1 on the PCE, and I don't know what the year over year on the PCE was at all. But let me just guess. Let me just throw out a number and say, if it was 0.4 a year ago and we get 1, then the tenth PCE year over year is going to decline 0.3. So, but I don't know what that number is at all. So I just totally made up a number here. But the CPI was next month. The CPI, well, it's this month now. The next report, we're looking at a very easy to beat number. I think it's a year ago for August, we're looking at a 0.5% rise. So if we only rise 0.1% in August, we're going to see a decline of 0.4% next month. This is the reason why I said we're going to have very favorable numbers for the next 2 months, because the year over year comparisons are extremely easy to beat.
Okay, and I wrote this down earlier when you said this, and I think you're explaining why you said it. You said it, you wouldn't be surprised if in 2 to 3 months we're getting CPI, headline CPI readings down in the 2.2 to 2.3.
Yeah, that's why I just explained it.
Yeah. Okay. All right. Well, look, I'm looking at the time. There are a couple of topics I want to get through before we wrap up here. Let's start getting into the so what of this. Okay, so Mish, you're pretty confident that we're heading into recession here. Obviously, that means tougher times ahead economically. People obviously should be, I would imagine you would tell people they should be doing the battle planning now, especially if you work for a paycheck, asking yourself, how safe is my job? What would I do if my hours got cut, or God forbid, I came in and found out the company laid me off? So that's all the stuff that I think that's just prudent stuff to be doing given the kind of outlook that you have. From an investor standpoint, what are some of the things that you would be, encouraging people to consider as just sort of prudent things to take into account given the type of outlook that you have here?
Well, one of the themes that I've seen on Twitter, I don't know how prevalent it is elsewhere, is this idea that the market doesn't decline until the Fed does the first cut. So people were, predicting, until the Fed cuts, I'm just going to stay in the market. I didn't buy that, and we had a pretty big decline, and maybe most of it's eaten up, back. And if it continues on to a new high, I think people will have gotten lucky. I think we're going to see some negative revisions to corporate earnings, and I still don't think that this is going to be a severe recession from an unemployment standpoint. However, the amount of consumer debt that's out there is really troubling, especially millennials and Zoomers, and housing rates to be weak for years to come. I think way too much is priced into this market. And I don't know if you follow, the Schiller PE, whatever,
Sure.
it's just everything has been way more exuberant than I would have expected, Adam. So I'm not the best person to ask this because I've been too pessimistic and I admit it. So I've kind of got a view of admit your own mistakes before someone else admits them for you. And this market has surprised me, Adam.
Okay, so this is not personal financial advice. And I understand your gun shyness, given how long the bear market has continued in the face of a lot of challenging data. And you and I have,
Bull market,
yeah, what did I say?
bear.
Oh, sorry. Yes, thank you. I meant bull market. This bull market has continued. And Mike, you and I have known each other for a long time, or definitely over a decade. And we've had a lot of back and forth about the data and the mismatch it many times with what the market was doing. But I value your opinion. I think a lot of viewers here value your opinion. Are there things that you're doing right now in your investment, in your investing, given the outlook you see coming here? And again, you're not offering personal financial advice, but are you reducing your general exposure to stocks? Are you buying more into bonds? If so, is it more treasuries versus corporates? Are you just riding the T-bill and chill wave? What are you thinking about in this
It's a
environment?
barbell strategy. It's kind of different than anyone else's. My wife is super conservative, has just, been in high grade, corporate bonds, not bond funds, holding them to term. Impossible to lose any money in these things. Now you just don't make a lot, but if you have no debt and you don't need a lot of money, you don't really need a lot of income. It's just a safe place to be. I've been in a lot of private placements. They're very illiquid. I think they're going to do well. So it's just a different kind of mentality, let's say. So it's not going to a strategy that's not going to appeal to hardly anyone, but it works for us.
Okay, so and again, not personal financial advice, but to understand how you're playing this given your outlook, you're basically saying, hey, we're going to take a super safe approach, but then have some of our portfolio, I'm assuming it's a minority, that's in the asymmetric upside camp, meaning, yeah, it could go to zero, and if it does, we're going to be okay because the majority is in all the super safe stuff. But if this stuff takes off, man, it takes off, and that could be cool.
It's probably more aggressive than that, but that's essentially the idea, yes.
Okay. All right. Look, you said, you don't expect this to be a recession that has massive job loss. And you and I have talked about this in the past, but it might be worth revisiting it here for a second, because I believe your rationale for that is that we're not going to see as many, well, boomers are retiring. They're leaving the workforce. And so employers aren't going to be able to not necessarily have the need to shed as many people because they're losing boomers to the just the organic churn of them just aging out. Is that correct?
Yeah, there'll be more buyouts. I was looking at that Intel announcement. They're going to try and do as many of those as they can with, buyouts rather than, buy, that kind of thing. I think we're going to see more of that. Of course, that only applies to, the fairly large companies, 250 or maybe 100 employees and more might be able to do that. Those 49 and under, it's just going to be buy, right? So we'll see. But I'm not expecting a 2008 here. People have a lot of equity in their houses, although if they need to sell that house, housing's already fairly illiquid. If someone needs to sell right now for some reason, then where are they going to rent and how much is that rent going to cost? So, I don't know, but we're seeing record Adam, numbers of people up to age 27, living with their parents here. And interestingly enough, more men than women. But so that will cushion things, somewhat. And if more people move back home, well, maybe we see some, declines in rent and home prices, people getting a little bit more desperate to sell. It's like, I just got to get out of this. I can't afford this anymore. I can't afford my mortgage payment. And that especially applies to anyone who bought, when interest rates were, 5.5% or 6% or higher.
All right, so housing was the next question. I have a question I'm working towards, but getting there through housing is a good way to do it. All right, so Mish, what is your general outlook for housing here? It just from your last answer there, it sounds like you think that today's record high average prices are likely to not sustain. And there's a narrative out there that, hey, we just need to get to where the Fed starts cutting rates, and that's going to save the housing market. Do you believe that, or do you have a different outlook?
No, I think we would need a crash. That's really what we need, Adam. To be honest, we need a housing price crash.
Well, to make houses more affordable to a widespread average of aspiring buyers, I agree with you. Do you think we're going to get a crash?
I don't think interest rates are going to come down to the 3% that everyone got, and if they refinanced in 2021. We had 3% interest rates where one could a window around that for nearly a year, and we had maybe 3 or 4 months off the top of my head where one could have refinanced under 3. That put a lot of extra money in everyone's pocket who did that. Not just then, but continuing, ongoing. This is one of the things that has probably kept retail spending strong. Right. 2/3 of the people own their own house. They're refinanced, or if they're rich enough, have totally paid off the house.
They probably also own financial assets, which have done well too. So
yeah, they own financial
double
assets.
boom. Yeah.
Who doesn't? Okay. In general, blacks, young people, the discrepancy between black home ownership and white is the largest in history. And most Zoomers were never able to save up. Generation Z, I call them Zoomers, enough money to ever afford a house. And they watched the rent go up and up and up and up. And then they watched interest rates go up and up and up. It's that combination. So and I don't think we're going back to 3%. So does 5 do it? Okay, well, 5 will get more sales, but how much do home prices come down? I don't know. It takes both. It takes a significant dip in both of those things. And the Fed created all of these bubbles with its QE problem, with its QE projects, and I don't know how they
and ZERP.
How do you undo it? I don't know how they undo this, Adam. That's what, maybe it's possible, but I just don't see it.
It was sort of shockingly depressive. I interviewed Ivy Zellman earlier this week, Mish, and I was sort of asking her a variant of this question, and she said, it's a big problem. And she said, look, I mean, maybe we are now renter nation, right? Like maybe we are a nation where just, the wealthy, the affluent, end up owning all the real estate and just rent a bunch of it out to everybody else that can't afford to buy. And maybe we've crossed that threshold. I mean, I've warned that we were on that path and someday we could get there. But the fact that a real estate analyst, especially one as highly respected as Ivy, kind of shrugged and said, I don't know, maybe we're there already. That really caught my attention. So I don't think she even knows.
Yeah, that would catch my attention too, but it's still 64-36 roughly, 64% owned, 36 rent. The
embedded base, but if you look at the transactions happening from here,
oh yeah,
it's much higher now on the highly affluent. Right.
Yes, and they're all cash sales. A huge number are all cash. Not all sales is probably, someone who has enough money to afford to sell one house and buy another, perhaps sell a house and buy a condo. If you have no real estate right now at all, unless you make a lot of money, and that's another thing, wages have stopped going up. And now, I've got a question for you. Where do we stand with Case Shiller? Did Ivy mention that? Case Shiller is what, the data is like 3 months behind, and then the report is 3 months behind, and then that report is from the 3 months prior. So we're maybe 5 months behind or more on Case Shiller. Are these increases we're seeing now real? Did you ask Ivy that?
We didn't get into the specifics of like the Case-Shiller index, but just to use the title of the interview, which was straight from Ivy, which is it's going to be tough out there for housing going forward. So she thinks that lower prices are ahead, but it's probably going to be more sort of a grind downwards than any immediate washout. But yeah, she's when it comes to residential real estate, she's not very pessimistic. And of course, we didn't even have time. I'd hoped to get into commercial real estate with her too. We agreed we'd have to punt on that just because there was so much to talk about in residential. But of course, in that one, there's a lot to be really pessimistic about, at least in some of the big areas like office.
Well, if I'm seeing it roughly the same way she is, then I consider myself in good company.
Okay, good. I think you are. All right. Well, look, two quick things. So I just want to mention a headline of one of your recent reports, which was a $150,000 house in 1988 now costs $707,500. Thank you, Fed. And I just wanted to mention it because you were making the case for that comment about a minute ago. So where I'm kind of going with all this, Mish, is you think there's a recession coming. You think the markets are going to go through a repricing. And that's going to hurt, obviously, the vulnerable, right? And largely right now, that's the younger generations, right, who haven't been able to amass capital, and they've had a harder time, and everything's super overpriced with a huge surge in cost of living that we've had, right? What I want to just ask you to opine on for a moment is, okay, so the generation that's doing the best right now is the boomer generation, right? They own the homes, they own the majority of the financial assets. They've been much less impacted by the rise of cost of living because the assets they've owned have gone up. That's all true on average, right?
Yes.
But when you look at them at a median basis, it is a very different story. There's a lot of rich boomers there that are pulling the averages up. And I just want to, because you're sort of like, yeah, I don't think the employment's going to be that bad because you're going to have a lot of boomers like retiring out. Yeah, we're going to have some boomers that are going to be fine no matter what happens. But I think we have a retirement crisis already with the current boomer generation. When you look at like the median and below in terms of how much they have saved for retirement, the median retirement savings is like almost nothing.
Yeah.
And even the average retirement savings isn't that much when you think it has to sort of fund 15 to 20 years of somebody's lifestyle. But the way it works out is it's a fat tail curve, where it's a long tail curve where there's a bunch of people, or a small number of people have a ton of money, and then a lot of people who really don't have that much. So if we go into this environment where there are layoffs, market financial asset prices go down, and housing prices go down, my concern is that's going to shift even more boomers who are in the okay state for retirement to the not okay state for retirement, and they don't have time to necessarily make that back up.
Sure.
Could that actually make this recession feel worse than you think it is? Where like, okay, maybe we're not having as many boomers getting laid off, but even the ones that retired out, like a lot of them now are realizing their money's not going to make it anymore.
Absolutely. And I think this, ties back to my observation that, people on my own website, despite me spelling it out, what's happening, say, well, Mish, you're wrong. Prices are up, 25%, whatever. You know, this CPI doesn't match my, my observation. Well, the thing is, I mean, everyone's CPI is an individual thing. If you're in school, that's one thing. If you're buying your own healthcare insurance, mercy. If you live in a flood or hurricane zone, even if you or fire zone in California, the I'm seeing reports where people's insurance is as much as their mortgage payment or rent or higher, out there. So even some people who, own their own house, if they hadn't, managed their finances well, heading, up towards retirement, perhaps they still own a fair amount on the mortgage, even though they were able to refinance it low. And now insurance costs have eaten up all of their extra money that they got from refinancing low. There are a lot of people, I believe, Adam, in that state. I don't know how to put a number on it, but I sense it from all the people who tell me, and this comes out in the political polls too. You see the economists sitting there saying, well, the economy is much better than you think it is. Well, are you in their shoes? That's the problem, because it's all individual, and there's huge segments here, insurance in California or Florida, or any of the hurricane zones. Um, People can't handle anything if they get into, if their car needs a $500 repair, they don't have it. There are a lot of people in that boat, and unfortunately, a lot of them are probably the most vulnerable of being laid off.
All right. Well, look, this is an important topic that I'm going to, I've been talking about, but I'll keep talking about more on this channel. And Mish, I'm sure your audience is similar to mine. The YouTube stats show that people watching these videos are 2/3 45 years old and more. So we got a lot of retirees. I think a lot of people who watch this channel are other people who have crossed that finish line of saying, hey, I think I've got enough assets. I'm going to be able to be good the rest of my life, but I don't want to get pushed out of that, that nice position. Or people who are, on track to get there or aspiring to get there, right? And I just want to make sure that, given everything that might happen in the future, especially if it follows the script you think it's going to follow, that as many people watching this end up on the good side of that line than fall below it. So anyways, thanks for going through all this with me. I'm going to start wrapping it up. Just a 30-second question for you. Give me just your quick bullet. I'm just checking my notes, and I realized at the very beginning, I said I was going to ask you about China, which I know is a whole discussion in and of itself. But short answer, if China is weakening here more so than the world expected it would, what impact do you think that's going to have on the global economy? China's kind of pulled us out of a couple recessions in the past, highly unlikely to do so this time. But if it's weakening here, is it a force that could actually pull us into the recession that you see coming?
I don't see China as a savior here. I just don't. They've gone through a property bust that they've not recovered from yet. They are still export dependent. The leadership has just, in my opinion, done all the wrong things. They need to be supporting consumers, not supporting exporters. And this is the weird thing here, in the United States, you can't find anyone, maybe other than you and I, or very many people, who are willing to say, the free market is good. Here, look at what just happened in solar panels. We had another major bankruptcy in a company that was getting subsidies from the Biden administration to install solar panels. What happened to them? The Biden administration demanded that we manufacture the solar panels here in the United States, rather than taking cheap panels from China and having a lot of installation jobs, and hauling jobs, trucking jobs, everything associated with putting those panels on. We trash the whole industry because we say, well, we have to make them here in the United States. the price shot up, nobody wanted to buy them. And then also in California, as you're aware of, there's so many people, had already done this that they didn't want any more power at, during the daytime. They wanted power at night. So a culmination of things hit this. We're doing the same thing now with EVs. Okay, we want EVs, but we want to make the batteries. Great. We want EVs, but all the parts have to be made in the US. So what are you doing? You're driving up the price. So what is China doing, to get back to your question? China is subsidizing US consumers, and we're saying, we don't want it. We don't want it. We'd rather have US consumers pay more. And I think we're going to see that no matter who wins the election, probably more so Trump than Kamala Harris.
Because tariffs, correct?
But that's what's going on. And I see all of these inflation pressures because of this. Just in time manufacturing is now just in case manufacturing. Do I need this? And at what price? So unions have already driven up prices, and they're going to go higher. And Trump, neither Trump nor Kamala Harris is going to want these imports. So what does China do then? If we manage to shut off China, what does China do? I don't know the answer to that question, but I hope it isn't war. And so anyway, I don't see China as a savior. They can no longer count on real estate. They've got an aging population, actually shrinking, if I'm not mistaken. India has exceeded the population of China. And my gosh, what happens if India, wants to industrialize the way China did? What is that going to do for carbon and all that kind of stuff? I just see a lot of inflationary pressures here. It's going to prevent the Fed from cutting as much as they have in the past. Too many wins in front of them. So what does that mean for the economy? Slower, stagnant growth for quite some time.
All right. Man, you just raised a whole bunch of questions I want to dig into, but we're going to have to save them for next time, Mish. Hey, thanks so much. Another just wonderful, enjoyable data pack conversation. For folks that have really enjoyed this, Mish, especially if maybe for some of them this might have been their first exposure to you, at least on camera, where can they go to follow you and your work?
Mishtalk.com, M-I-S-H. Mish is my nickname. It's the first two characters of my first and last name, Mike Shedlock. So mishtalk.com. And if you're interested in photography, please check out Mish Moments, M-O-M-E-N-T-S, mishmoments.com. I think I've got some world-class photography out there that you might enjoy, even if you don't like my economic forecast. Maybe you like my photography. So check that out too.
All right, Mish, when I edit this, I will put up the links to both Mish Talk and Mish Moments here on the screen so that folks know exactly where to go. Folks, links will be in the description below this video too, if you want to get there with just one click. You've got one of your pictures there behind you there on the wall, Mish, and I will say for folks that haven't seen your photos, they are phenomenal. I mean, they look like they're off the cover of a National Geographic. You got a lot of great starscapes, national park videos, floral, like wildflower. I mean, it's if you're into that type of stuff, you're really, really good at it. All right, folks. Well, look, in wrapping up here, if you'd like to have Mish come back on the program again, whenever there's something that's got him particularly mobilized on all the data that he publishes on a daily basis, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you're wondering how you can navigate your wealth through the type of future that Mish sees coming through here, highly recommend that you work under the guidance of a professional financial advisor that understands and takes into account all the macro issues that Mish and I have discussed here today. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. and one of the advisors will be in touch with you shortly. And as a reminder, these consultations are totally free. There's no commitment to work with them. There's no strings attached. It's just a free public service that they offer. All right, Mish, this has been great, my friend. We didn't actually get to making a bet for end of 2024, so maybe we'll have to do that next time. But I'm so glad you got to enjoy the 2 beers and 2 pizzas on me. They were well-deserved, and really look forward to having you back on the channel again soon.
My pleasure, Adam. Thanks for having me on.
All right, and everybody else, thanks so much for watching.